Welcome to this explainer. Right, let's dive straight in, because what we're looking at today is, honestly, a massive structural dislocation in the global markets. Think of the silver market kind of like an iceberg. Above the water, you have the surface level volatility, the daily paper price that everyone watches and reacts to. But below the surface, there is a deep structural reality of supply deficits and geopolitical accumulation that is telling a completely different story. Today, we're going to examine that hidden divergence.
Now, I want to hook you right off the bat with a single number, 659. As of recent market closes, 659 is the literally staggering number of silver ounces it currently takes to buy just one single share of the Dow Jones Industrial Average. Keep that number locked in your head because it perfectly illustrates the central puzzle we're going to unpack today.
To put that into perspective, let's jump back to 1980, when silver hit its previous all-time high. It took just 18 ounces to buy the Dow. 18! Today, like I just said, that exact same purchase is going to cost you 659 ounces. So even with silver's recent rallies, stocks are effectively 36 times more expensive relative to silver than they were at that 1980 peak. It's wild. It really just brilliantly illustrates how far real, physical assets and paper equities have completely detached over the last few decades.
So, how on earth did we get here? Well, here's our roadmap for this explainer. We'll be looking at 1. The paper market illusion, 2. The 40 trillion debt trap, 3. Industrial demand and deficits, 4. East accumulates physical silver, 5. The state legal tender rebellion, and finally, 6. Watching the observable data.
All right, starting with Section 1, the paper market illusion, a 14-day volatility roller coaster.
Let's take a look at the surface-level events that have been really shaking out leveraged traders lately. Silver has been moving with the wild volatility of a small-cap biotech stock. It's absolutely wild. On April 30th, silver was sitting at $71. Just kind of a boring sideways market. Nobody was really talking about it. Then, May 10th and 11th hit. News of US and China tariff reductions sparked this massive rally because the market suddenly priced in an industrial demand boom. Silver just rocketed. But then, May 13th happened. We got a hot CPI print, so high consumer inflation, along with a massive jump in wholesale PPI. Suddenly, the market totally priced out rate cuts, and on May 15th, silver mechanically crashed 10.6% in a single session, down to $77.52. So the absolute crucial takeaway here is this: that 10.6% crash, it was just a forced, mechanical unwind of leveraged paper longs reacting to inflation data. It had literally nothing to do with the actual physical fundamentals of silver changing.
Moving into Section 2, the 40 trillion debt trap. Why the Federal Reserve is cornered. To really grasp the structural trap the Fed is in right now, we've got to look back at 1980 again. Back then, Paul Volcker crushed inflation by hiking rates all the way to 15%. Now, he could actually do that because the national debt was only about $1 trillion. It was definitely painful economically, but mathematically, it was possible. Fast forward to today, and the U.S. national debt is closing in on an astronomical $40 trillion. If you run the math on a hypothetical 15% rate today, the annual interest expense alone would climb to an absurd $6 trillion. That is simply mathematically impossible without completely breaking the federal budget. So the very tool Volcker used to save the dollar, it's effectively been removed from the toolbox. The Fed is completely cornered.
Next up, Section 3, Industrial Demand and Deficits, the physical reality of silver.
Okay, let's dive below those paper prices and look at the actual physical metrics of the metals themselves. For 30 years, gold and silver essentially moved in lockstep, right? Gold led, silver followed. But as you can see, that relationship has visibly broken. Why? Well, because they're trading on entirely different forces now. Gold is trading on monetary forces. Central bank reserves are growing, supply is tight but stable, and it's acting as a hedge against currency debasement. Silver, on the other hand, is heavily driven by intense industrial forces. It's deeply tied to tech and green manufacturing, and frankly, it is facing a severe structural shortage.
Let's actually look at the hard numbers documenting that shortage, because they're pretty eye-opening. According to the Silver Institute, we are currently in our 6th consecutive annual supply deficit. Yep, 6 years in a row. They're projecting a 46.3 million ounce shortfall just for the 2026 calendar year. And honestly, the most staggering stat of all, 762 million ounces have been drawn down from global above-ground stocks since just 2021. So while paper prices are swinging wildly on interest rate rumors, the actual physical reality is that silver is draining, and it's draining fast.
Which brings us to Section 4. East accumulates physical silver, a massive global shift.
This dramatic draining of physical metal leads us straight to a massive global shift. Because while the West is constantly obsessing over paper prices, the East is out there actively accumulating the physical stuff. Over in the West, we're seeing all this paper selling, which has actually drained COMEX physical inventories down to a dangerously low 13.4% delivery coverage ratio. That basically means there's barely enough actual metal sitting there to back the paper trades. But in the East, physical buyers are willingly paying a massive 11.8% price premium on the Shanghai Exchange over Western spot prices. Plus, China recently imported a record 836 metric tons in a single month, literally the highest ever recorded. Now, in a normal market, arbitrageurs would just buy cheap in New York and sell high in Shanghai, right? That closes the gap. But the fact that this 11.8% premium persists, even when Western prices crash, tells us one absolutely vital thing. The immediately deliverable physical silver in the West simply isn't there to satisfy the trade.
And it's not just Chinese industrial buyers either. The Russian government has formally added silver to its national reserve plan. This isn't just a casual purchase. This is a sovereign-level commitment, treating silver as a strategic asset right alongside gold and oil. When a nation-state buys silver, they aren't buying small quantities, and they definitely aren't flipping it on a day trade. It goes straight into sovereign vaults and is permanently removed from circulation, period.
All right, moving on to Section 5, the State Legal Tender Rebellion, constitutional money in the U.S. Now, this rebellion against paper currency isn't just happening overseas. A parallel structural shift is happening right now inside U.S. state legislatures. While most people are completely glued to what the Fed is doing, a growing list of states are effectively saying, you know what? We've seen enough of this debt trap. States like Alaska, Texas, Florida, Kansas, and actually a growing list of others have passed legislation recognizing gold and silver as legal tender. They're looking at the exact same math we discussed earlier, and they are quietly returning to the constitutional recognition of metals as actual money.
So, how does this actually work in practice? Well, it usually happens in two main steps. First, states remove capital gains and sales taxes on these metals, so they're treating them as actual money rather than just a taxable commodity. Step 2 then enables the framework for a dual currency system. Now, whether you lean left or right politically, the economic effect here is exactly the same. This is a structural, legal challenge happening on a state-by-state basis against the Federal Reserve's monopoly on money. It's essentially a move toward a lifeboat of physical assets.
Which leads us to our final section, Section 6, watching the observable data, navigating institutional confusion. With all this hidden divergence between paper and physical markets, you've got to wonder, how is the smart money reacting? Well, you'd think the top institutions have this entirely figured out by now, right? Nope. UBS slashed their 2026 target down to $80. JP Morgan is sitting at an average of $81, and then you have Bank of America with an upper bound scenario modeling all the way up to $309. Let that sink in. Both desks are looking at the exact same data. The incredibly wide spread here proves that even the best resourced experts are completely split on what happens next. The smartest, highest paid analysts genuinely just do not know.
So since we clearly can't rely on institutional price forecasts, you need to track the observable, verifiable data yourself. Think of this as your personal toolkit. First, track the Shanghai Gold Exchange premium percentages. If it stays high, you know that physical tightness is real. Second, monitor the COMEX registered inventory. Specifically, watch that 75 million ounce threshold. If it drops below that, we're approaching a major stress point. Third, follow the FOMC minutes. Those are the Fed's internal meeting notes to see if they are internally trapped between fighting inflation and servicing that massive $40 trillion debt. And finally, check PMI data to see if inflation is actually being matched by real economic strength. Seriously, don't just take my word for it. Pull these numbers yourself.
And that brings us to the end of our explainer. We've just seen a 10% paper crash driven by mechanical trading layered right on top of record physical deficits, massive Eastern accumulation, and U.S. states legally restoring metals as money. So I want to leave you with this final thought to chew on. When the paper markets and the physical reality completely detach, which one are you trusting to hold its value? Thanks so much for watching. Stay curious and keep learning.